I'm here with Bruce Cooper, Chief Investment Officer at TD Asset Management. We're here to talk about the shocking, stunning, at the very least unexpected results that came out from the United States last night. Bruce, this is, I think a lot of people woke up this morning who didn't see the results last night, completely shocked by what had happened. Social and political, ideas aside, we saw a huge sell-off overseas when the results first came out, but it seems to have moderated a bit. Yep. Markets hadn't priced this in.
No, definitely. This was not the base case scenario. I think most people anticipated that Hillary Clinton would win the presidency. That's what the polls seem to suggest. And then that the Republicans would retain control of the House of Representatives, and that kind of divided government would give us something like the status quo, because that's what we have now, a Democratic president and Republicans controlling Congress. So this is a surprising outcome, and the market does need to wrap its mind around that.
What does this mean for investors? I mean, I know that's a loaded question. I think you could maybe say in the near term, medium and long term. But just, what do you think? Well, what do we need to start paying attention to?
Well, there are for sure things on either side of the ledger. And I think the initial reaction will be for markets to be down a little bit. That's what you referred to. They were down overnight, and I think they will be down a little bit. I think the things that concern investors are trade, first of all. Clearly, Donald Trump has been very vocal in his opposition to the North American Free Trade Agreement, to TPP, and I would say generally to trade deals that we have out there. And companies have been big beneficiaries of free trade over a long period of time. And so I think markets will be a little worried on the trade front. Clearly, he's been vocal about the Federal Reserve, and particularly about Janet Yellen. So I think some uncertainty is introduced on the subject of monetary policy. And he is a pretty unpredictable character. And I think markets don't like unpredictability. And so we don't know how he's going to react in many situations. So I think those are the things to be concerned about on one side of the ledger.
I think, when we heard the campaigning, I mean, people kind of felt, I'd say at least the commentary was that perhaps his policy wasn't as well formed, perhaps as others. But there's a few things he mentioned. I mean, trade obviously was very clear. You talked about the Fed, which I'll come back to. Tax reform. He did talk about personal and corporate tax reform, or alluded to it. So
this is really, there are some things on the other side of the ledger from a market perspective that I think people will focus on. Tax reform is one. He's talked about lowering tax rates, both personal and corporate. On the corporate side, I think that would be considered benefit from an earnings perspective, and so we could see that. Also, he's talked about allowing companies to repatriate earnings they have offshore. A lot of companies have big cash piles offshore. They'd like to bring it back to the United States, but if they do so, they'll be subject to a very high tax rate. He might lower that tax rate, which would be beneficial to companies. And so for sure, on the tax side, I think there's some cause for optimism from a market perspective. The other one, I think, is fiscal policy. He's been quite vocal about his belief that we could have an aggressive fiscal program here.
I think we're talking about how I think Hillary Clinton promised, I think it was $275 million in fiscal spending. Billion, excuse me. Yes, makes a big difference in the economy. So $275 billion, he promised to double that.
Yeah, he's talked about the fact that America's infrastructure is broken and that we need to very aggressively invest in that infrastructure. I think that would be considered as a positive from a market perspective. And that's an area where there's actually some broad agreement, I would say, between parties. And so we could actually see something get done here. And we're seeing that around the world. Here in Canada, of course, we're seeing spending on infrastructure as well. And so that would be a tailwind to growth. And I think the market would like to see that.
What about energy companies? We got the sense as well that he would be more friendly towards, I think, the traditional energy complex. Is that something you could see happening as well?
Yeah, it could have an impact on companies' ability to drill in certain areas. It could have implications for tax policy. Of course, the biggest issue for energy companies is the price of oil, which will be driven by broad economic growth. But the perception for sure will be that he'll be more supportive of, say, the traditional energy industry, oil and gas, and less supportive of alternative energy. I think we could see a sell-off in alternative energy and maybe some support for traditional oil and gas here medium term.
I think a lot of people were listening to, how he campaigned and wondering at this point a couple things. Will his policies that he actually puts in place be more nuanced than what he was campaigning on? And secondly, will he have the support of Congress, even though it is a Republican Congress.
Yeah, I think first of all, on the first question, I think that's very tough to tell. I mean, he's never been a politician. Yeah. He has not thought deeply, I don't think, about policy issues, and so we'll have to see how that unfolds. I think the issue relating to how he will relate to his own party, if we can call it that. I mean, actually, Donald Trump's not really a traditional Republican, so I think that's going to be a fascinating one. He's a bit of a maverick. So I think he'll be able to get certain things done. You know, we talked about infrastructure, maybe some stuff on the tax side, but it's also possible there will be areas of friction within the party. And, you know, to some extent, we might look to Congress to be a restraint on Trump, because, of course, the president can't do whatever they want. Bills need to originate in the House or in Congress. And so, you know, that could be a source of constraint for the president in this situation.
You have been talking to me for a long time, since for years now, about the importance of income inequality and, you know, I'd say lack of social mobility and those trends happening around the world. I mean, we're seeing that happening in places, and you know, it's really coming forth in the United States. At least that's the message I think people are getting. What does that mean for economic growth and for the investor?
Well, you know, I think you're right to point to this as a root cause. We saw this with Brexit as well. I think one message to take from this is that the country is very, very divided. You know, Trump won a pretty big victory, but of course there are tens of millions of people on the other side, and a lot of people who supported Trump in these Rust Belt states like Wisconsin and Michigan and Pennsylvania, you know, are people that are just looking for change because they're not doing very well right now. And so we'll have to see whether it's the United Kingdom with Brexit or the United States, how it resolves this issue of income inequality. But broadly speaking, you know, we think of income inequality as being a negative for economic growth, because to the extent you've got, you know, the lower part of the income spectrum with not a lot to spend, that means the consumption is under pressure. And that's what we've seen. The consumer is not very robust in the United States. And that's a trend we'll have to watch very, very closely.
He mentioned when he was campaigning that he was not supportive of Janet Yellen. He wanted to replace the Fed chair. So there's that. And also, what do you expect to be happening in December from the Fed?
So the market going into this election had priced in something like an 80% probability of a rate hike at the next meeting, 25 basis points. And I think it'll be interesting to see the market volatility that unfolds in the next little while. The Fed has showed that it is mindful of volatility. And you know, if we get a big market reaction, they could step to the sidelines. I expect their base case is they would still like to hike by 25 basis points. Look, the economy is okay. It's not going great guns, but jobs growth has been pretty decent. Wage growth is actually the highest in this cycle. So I can imagine that we'll hike 25 basis points and then sit on the sidelines for a pretty long period of time. To be honest, that was our base case expectation anyway, that we might get one hike in December and then a long period of sitting on the sidelines.
And who's going to be overseeing that process? Will it be Janet Yellen?
I anticipate it will be Janet Yellen. Of course, Donald Trump has been critical of her, but I think it would be difficult to replace her, and we do anticipate that she'll be in chair probably till the end of her term.
Final question for you. What does this mean for the Canadian markets or the loonie? I mean, you know, what we saw, you know, initially quite a move in the Canadian dollar down.
Yeah. Yeah, you know, traditionally the U.S. dollar is a safe haven currency, and so when you get uncertainty in markets, the U.S. dollar is up and the Canadian dollar is down. I think that's what we're seeing this morning. I think that's a reasonable expectation. You know, we've been cautious on the Canadian dollar in any case, really because we think the Canadian dollar, the Canadian economy is pretty subdued. And obviously the price of oil has come up a little bit, but it's not at a level where we're going to get a lot of investment in the Canadian economy. So we think the Canadian dollar is yet another one of these kind of lower for longer kind of securities. And from a short-term perspective, to the extent there's market volatility, which I think we'll see short-term, I think the U.S. dollar probably a bit stronger and the Canadian dollar a bit weaker.
Just final thought, pulling right up here, you know, what do investors need to keep in mind as this unfolds? Because, you know, it's going to be bumpy, I expect, over the next little while.
Yeah, you know, I think this is the kind of time we need to remind ourselves, focus on the long term, because there is a temptation to react, which is normally the wrong thing to do. So market timing, we know, is incredibly difficult. If you sell today, you're faced with the very difficult problem of when do I get back in? We're trying to build very diversified portfolios of very high quality assets, investing in companies that will be around tomorrow, the next day, 5 years from now, 10 years from now. They will get through this challenge, and the portfolios are built to withstand this kind of volatility. And so I would encourage folks to be mindful of what's going on in the world, but not to react to what's going on in the world. Understand your objectives from a long-term basis and build portfolios around that.
Bruce, thank you very much.
Great to be here.
Bruce Cooper, Chief Investment Officer at TD Asset Management. I'm Kim Parley. Thank you for watching.